The Fed calls raising two key interest rates an aggressive attack on inflation, saving you and I money when we buy consumer goods. But if we're buying on borrowed money, higher rates may not be good news. Financial analysts say the federal rate hike will raise most other rates. After today's announcement, some local banks like AmSouth, Compass, South Trust, and Sun Bank began raising their prime rates almost immediately, and more banks are expected to follow. Those increases will be passed on to you and me by affecting things like credit card interest rates and home equity loans.
That'll be passed along to the borrowers, such as commercial businesses and also probably the home buyers too.
Nationally, higher rates are already affecting construction of new homes and apartments. Housing starts fell 2.5% in April.
As a result of rate having gone up, about 50,000 people have been priced out of the ability to buy a home.
But that may not be the case here along the Gulf Coast, where building activity is still very strong. Mortgage broker Jim Gamble points out we still have some of the best mortgage rates we've seen in a decade.
If we can keep inflation and the fear of inflation down, we ought to be able to keep the mortgage rates down.
And if you're in the market to buy a car, you may have to pay a bit more. Auto loan rates will rise slightly. Now, on the flip side, if you're a money saver, the new interest rates may be good news.
The savers, of course, have experienced low rates lately, and it's been a difficult time for the retired people and people living on a fixed income with rates this low. And I think we'll see a little bit of an increase in short-term rates, which hopefully will pass along to the people with money market accounts and investment products and things like that.